Good morning, everyone, and welcome to today's meeting of the Scrutiny Commission. As usual, this meeting is being broadcast live to the public, and for those not able to watch live, the webcast will be recorded and made available for viewing on the County Council's website after the meeting. Before we begin, can I please remind everyone to only turn on your microphones when you wish or are invited to speak. So we move on to item 1 of the agenda, which is the appointment of chairman. Members are asked to note that I've been appointed chairman of the Scrutiny Commission in accordance with Article 6.05 of the County Council's Constitution. Moving on to item 2, which is the election of vice chairman. Can I ask for nominations for the position of vice chair, please? And Mrs. Fryer.
Thank you. I would like to propose Mrs. Rosita Page.
I'd like to second that.
Thank you. And so proposed by Mrs. Fryer and seconded by Mr. Barclay. We have Mrs. Page proposed and seconded as vice chairman. Is everyone in agreement? Excellent. Congratulations, Mrs. Page. And the next item is item 3, which is the minutes from the last meeting, which were held on the 9th of March. I move these meetings are taken as read, confirmed and signed. Is that agreed by all members? Yep. Okay, so we move on to item 4, which is question time. I've not been advised of any questions from the public for this meeting. So item 5 is questions asked by members under Standing Order 7, and I've not received any such items. Item 6 is urgent items, and I've no urgent items. Item 7 is declarations of interest. Do any members have any interest they wish to declare at the meeting? No. Okay, so item 8 is declaration of the party whip. Does any member wish to declare the party whip? Nope. And item 9 is petitions, and we've not received any petitions. Just to say that in terms of attendance today, Mr. Smith is substituting for Mr. Gillard, and Mr. Phillimore is substituting for Mr. Poland. Thank you for your attendance. And we move on to item 10, which is the first substantive item, which is the 2021-2022 provisional revenue and capital outturn, which starts on page 13 of the agenda pack. We have Chris Tambini, Director of Corporate Resources, who will introduce this item and is joined by Declan Keegan, the Assistant Director. And we've also got the lead member for Resources, Mr. Brecken, with us today. Thank you, Mr. Brecken. So, Chris, if you want to go ahead to present this item, thank you.
Declan is going to take us through this paper.
Chair. So the report just sets out the provisional revenue and capital outturn for the previous financial year, 2021-22. And a summary of the revenue outturn is set out in the table in paragraph 6. It just shows a gross underspend of £7.9 million. The main driver of that underspend was £8 million from the sort of council tax and business rate income, which held up remarkably well. It's obviously kind of a heavily pandemic impacted year last year, and even the unwinding of the related support schemes that were put in place nationally didn't have a detrimental effect. In terms of the main services themselves, there was a £2 million overspend in totality, and that was despite Environment and Transport and Children's and Family Services both delivering underspends of £4 million each. And the big cause of there was that the high needs service continues to be sort of a difficult one financially, and the grant was overspent by £11 million, which is actually £6 million more than we expected when the budget was set. So, you know, we knew we had problems, but just not that sort of extent at that sort of period of time. Adult social care was another overspending area, and again, it was sort of heavily impacted by the pandemic. We did receive £13 million of income from the NHS that helped with the additional cost, but despite that, the service still overspent by £2 million, and that is that NHS income is one to keep an eye on this year as well, because the expectations are that it's going to be much lower, and it's just the question is whether the costs can come down as well in line with that. In terms of other services, corporate resources also overspent by £1 million. And again, it was COVID related. It was driven by the commercial services, which, you know, when you look at sort of our big ones, the sort of hospitality related, whether it's sort of food in sort of school settings or a place like Beaumanor Hall, they obviously got sort of clobbered during the pandemic and are still very much in kind of recovery mode, as it were. would draw members' attention to the sort of the section in the report on inflation. It's going to be a key challenge over the next sort of few years. We're not immune from it. It's not just sort of the cost of living crisis. A lot of the press is sort of it's a national sort of problem, but it's going to drive a lot of our costs as well. And there is quite a bit in the report that just sets this out, particularly the driving of the national living wages. Those kind of, as average earnings increase, the national living wage increases even more. When you're spending approximately £200 million a year on adult social care, every 1% extra that we have to pay is obviously sort of significant, and you can see that the numbers are huge. So, I mean, to put it in context, when we set the MTFS back in February, we knew it was going to be challenging. We couldn't close all the gaps in all the years. So by 25-26, we had a £40 million gap, despite having identified £54 million of savings. Now, if you look at sort of layering inflation on top of that, like I say, particularly for the national living wage, it could easily be another £30 million. So that'd be a £70 million gap by 2025-26. You know, it's a huge number, and we haven't even factored in things like the adult social care reform yet. So, like I say, if you're going to look at anything in the report, the inflation section is the one to look at, because that's going to be a recurring theme over the next few years. And it's in terms of sort of, I suppose, the challenging position and the uncertainty we've got as well, where the recommendations of the underspend were made. We put 3.6 million aside for the budget equalisation reserve, which is one just sort of reserve there just for sort of financial pressures. And again, I want to draw out is the early year expenditure in excess of grant. We often get differences between the grant and what we spend just because of sort of timing differences, and the grant's a bit fiddly in truth, or the claims for the grant is quite fiddly. It's never going to perfectly align. But the difference we've got this time is unusually large, and a couple of things have gone wrong in there around kind of the about how the sort of the grant's being claimed and the sort of provider payment. So internal audit is still working through that and investigating it, but it's not looking good in terms of reclaiming all that money. The other areas we've put another £1 million into transformation fund, and it's obviously just to help make sure we've got the sort of the people to help sort of solve the problems, as well as kind of people like myself flagging up the problems. And you've also got £3 million for the inflation risk, which is a one-off, so it'll help a bit, but it's only going to offset the problems that we're going to sort of need to solve. I was going to pause there, if that's okay, Chair, and then sort of take questions before the reserves or the earmarked fund section, the capital section.
Thank you, Declan. Mr. Barclay.
Thanks, Declan. I mean, I think the biggest worry is the potential £71 million shortfall by 25-26. Do you see that? Is there any realistic chance that the Fairer Funding Review in April 23 will assist us in that? Because the reasons behind that deficit are very clear. That it's not that we've done anything wrong. Inflation is adding a significant amount, 31 million. Do you think it's likely that, I mean, it's not just Leicestershire County Council, all councils are suffering. Is there a likelihood that we will at least get some more funding or better funding to enable us to deal with a situation which is really not as a result of anything that we've done wrong? It's just a significant demand led increase in costs and population increase and things like that. I'm just thinking ahead. We've made significant savings. We've tried everything we can. Now I think it's time that the funding comes up. We've talked about it for years. Is it likely to happen?
If it's okay, I can pick this one up. The fundamental review of fair funding that we'd hoped for, I think, is pretty unlikely. I think it's not going to happen this year for certain. There isn't the time for it to happen in the fundamental way that needs to happen, because that would require a couple of government consultations, and we've run out of time. And it's looking increasingly unlikely it will happen in future years. There is a bit of a rumour going around that there might be a bit of a funding consultation that might come out, but it's sort of before the summer recess. We'll have to wait and see whether that happens. If that does happen, that will be kind of tinkering around the edges. And one of the risks for Leicestershire is that they just end up maybe doing a bit of a data refresh or something more minor. And actually, there's certain things that could take place in the form that could actually make matters worse for us, and that would be really concerning. So, I mean, fingers crossed if something does come out before the summer, it does benefit Leicestershire, but it won't be the fundamental reform that we really need.
Thank you, Chris. I think Mr. Richardson, did you have your hand up?
Thank you, Chair. Just a couple of questions, if I may. First one is on paragraph 3B. Now, fully understand the situation that the county council's in, and what I'm interested here is not the schemes that the county council are financing, but where you have got large schemes across the county which are being funded by promoters. I believe that one of the things that could assist promoters is having better certainty of when roads that they are funding and being built will be adopted by this council, and therefore we will then take on the revenue cost of maintaining those roads. Now, there's nothing in this report or anywhere else, so I just wonder what our policy is, and do we need to review our policy on adoption of roads that we haven't built, if that makes sense to you, which have been funded by a developer, which might then give more assurance to promoters of schemes, which might then encourage them to take on the role of putting in the infrastructure to take away that financial liability from the county if they had more certainty. And on the second question really would be that I think through no fault of the excellent overtures made by senior officers and cabinet members here to increase our funding from central government. It's sad that we're not being successful, but it's not through want of trying, it's not our fault. Do we then need to start considering perhaps the unthinkable of looking to those assets which are underperforming, about doing the unthinkable and perhaps, you know, disposing of some or looking at other uses? You know, we've got one later in the report and in the following report which never seems to make money. So do we need to think the unthinkable, and perhaps is it time to dispose of things like Bow Manor Hall, which could bring significant income to this council through development of the site, not because we want to, not because it's top of our agenda, but just because we may well have to close that gap. And could I perhaps just urge the portfolio holder and yourself, Chris and Declan, to actually, you know, do that troll through our asset register just to see which underperforming assets may be there, which we could then consider. I said it's not something I enjoy saying, it's not top of my list. I just think it's something we may well need to do for the greater good of the county.
Mr. Bracken.
All I was going to say as lead member was all options and avenues are being explored. So we are obviously in a tight place. Funding doesn't look as though it's going to come forward straight away, but we'll keep on those fights. But everything is being looked at. I mean, Mr. Richardson's mentioned a specific asset there. Yeah, that is one that is on the list, and certainly I'll take on board the comment. So.
Yeah, I was going to say the same thing actually. That we're constantly looking at underperforming assets, and to be honest, if you look back at the potential shortfall, that kind of £71 million, you know, we're going to be increasingly looking at those kinds of things, and actually looking at some of the savings that, you know, in previous years, to be honest, you know, I know members don't want to do, but given that scale of shortfall, we're going to have to do some very difficult things. I'll leave the harder question for Declan. Adopted roads.
It's only because I don't know the answer. But in terms of your general point about kind of, you know, how do we shift the risk away from the county council to the developers to kind of, I suppose, enable that kind of sort of that infrastructure then to sort of get put in place? I think it's obviously in line with what we want to do, but to be honest, I don't know the answer on the adopted, but we'll take it away and sort of find out, because anything that helps, you know, it's worth looking at, to be honest.
Okay, Mr. Galton, I think you had your hand up.
Yes, thank you, Chairman. Just wanted to ask about this 9 million, paragraph 30, the 9 million, the COVID price costs, showing that COVID is still very much with us. That's a significant amount of funding, but presumably some of that has come back in terms of the grants we've got. So I just wondered if that was a net, or whether we've recovered some of that from government. That's the first thing. And then on the general inflation point, at the time of the MTFS back in February, you weren't that worried about it. And I think that if I understood that, the reason was you hoped it would be fairly short term, but obviously commentators have now changed the position, saying it could be now much longer term and inbuilt into the economy for some time. and you also say in this report, really, there's not much we can do about it. It's kind of out of our hands. So I just want to check we've got that right. The situation's worsened since February, the MTFS, in terms of the forecasting for local government inflation. And obviously there's lots of aspects to that, but the one that's really worrying at the moment is fuel costs, isn't it? Because so much of what we do, transport, whether it's contractors or we're providing it directly, is going to be hit. News yesterday, we're looking at the £2 a litre, is it now going to be close to? And prospects of the RAC saying that could go above that in the coming months. So fuel costs really do worry me. But yes, I was just interested in some general comments about why we think the inflation situation is getting worse. Thank you.
So in terms of the first question on the adult social care overspend, the report shows net of specific grants, so and in specific income. So, for example, the NHS income I mentioned, and that's all netted off of those figures. But what it doesn't include is the general COVID grants that we can use sort of anywhere. So, if you look at the sort of level of grant we got for COVID last year compared to the overspend, it has covered it last year. So that's worked out okay. In terms of the inflation one, you're absolutely right in sort of the way you articulated it, because around the time of the we set the MTFS, or when the MTFS was approved back in February, the commentary was very much that inflation is going to spike and then fall rapidly back close to the Bank of England targets. And the best one to actually look at is the IMF's forecast, because I think they did a forecast sort of tail end of January, and that's exactly what they said. But then when you look at the IMF forecast in kind of April time, I think it was, they're basically saying, inflation is going to go higher and it's going to stay higher for much longer. And the big differentiator between before and after the MTFS setting is the war in Ukraine. And that's just kind of turbocharged and extended both the kind of the commodities that both of those countries export, but also the supply chain disruptions. So it was already going to be a bit of a challenge, and we thought we'd probably got enough money put aside. But now that it's extending into sort of future years, it's going to be much more problematic, and you can start to see that ripple happening already. So we had expectations of what the National Living Wage was going to do, but then the Low Pay Commission did a consultation at the end of March, again post the MTFS being approved. Had rates in there much higher than what we were expecting. And to give you an example, the Conservative manifesto was to get national living wage up to £10.50. The Low Wage Commission now is suggesting rates that could get it up to about £11.50. And that's a 10%. And I mentioned that £200 million budget. That's £20 million there, just on kind of rough figures. So it's huge figures that kind of have only rapidly kind of come available over the last few months. You've always been able to find pessimistic scenarios that have said inflation is going to be much worse, but the mainstream commentary was actually big spike, fall back quickly to Bank of England targets. Now it's going to go higher and it's going to stay high for longer. So it's difficult. And the touched on the control point as well. It's very hard because we don't set our own pay rates, national negotiations. We don't set national living wage. That's kind of in the sort of the remit of the Chancellor. And we can control some of our contracts we negotiate with providers, but if the whole market's impacted, well, you still need it. So it's very difficult at the moment.
Do any other members have any comments they want to bring in? I mean, I would just say that, yes, obviously, when we were looking at the MTFS at the start of the year, it was already a challenging situation, but obviously the inflation alterations have made it an even more challenging situation now that sadly the more optimistic view of what was going to happen to inflation next year has turned out not to be the case, and we're having to get used to something we haven't had for sort of 30 or 40 years, which is, sustained fairly high levels of inflation, and therefore there is going to be a huge challenge for the council in terms of the financial situation, and unfortunately, as we heard, there doesn't seem to be much movement on the fair funding and the practicalities of getting that in. There's also obviously the disappointment that we weren't able to get in for the level 3 in terms of the county deal and so on. So unfortunately, it does seem to be quite a challenging situation. And I know that at the last council meeting, I think the financial situation of the council was described as grave in the paperwork, which is more serious than we've heard before. So unfortunately, it's going to be a difficult time ahead, but thank you for all you're doing in terms of trying to address the situation. Back to you, Deb.
Okay, I'll just briefly pick up the reserve section. It's quite a short section, so and I won't go through it in detail because the structure of the sort of earmarked fund is similar to previous years, and it does continue to be dominated by the capital earmarked fund, which basically just reflects the size of the programme, or sort of puts set money aside for that. The ones I'd pick out is the budget equalisation reserve. That's one that's grown quite a bit, and it was a conscious choice during the MTFS because we've got a financial gap in year 2 of the MTFS, which is not a position we like to be in. So we put cash aside, obviously, kind of to make sure we buy ourselves time to resolve that. And we also, obviously, kind of as members are aware, put cash aside to basically to fund the SEND deficits. You'll notice in there a bit of a funny, we've moved some of the balance to the MRP as a voluntary contribution. It basically just gives us a bit of flexibility financially for future years. If it's something we don't want to do, it's easy enough to reverse. It just takes a couple of years to reverse back out, but it just gives us some sort of flexibility between kind of capital and revenue sort of budgets. And then members may also notice it looks a bit odd. DSG at £24 million is lower than the high needs deficit earlier in the report at just shy of £29 million, and that's basically just due to school growth funding that's in there. So it's slightly misleading. It's just a bit of a difference, but we can't use the school growth funding. It's been earmarked to fund those additional places. So I was going to pause there to pick up any questions.
Do any members have any questions, comments on that part of the report? No. Okay. Back to you.
And then final section of the report is just capital. So the capital outturn, £36 million underspend on a £119 million programme, and virtually all of it is just slippage of schemes that are going to get sort of picked back up into the current financial year. And again, obviously kind of quite a disrupted year, but also it's a bit of the nature of the programme's change. And if you look at sort of the big variances in there, is primarily around the environment and transport programme, and it's primarily related to those very, very big schemes. And when you've got, I don't know, a 4 or 5 year sort of programme, sort of cutting it over financial years can kind of be quite problematic. And those schemes are prone to kind of unpredictable delays as well, just because the amount of approvals and arrangements that need to be put in place beforehand. But I suppose the thing I would stress on the capital, and apologies for making this quite a miserable report, but it's the £36 million underspend does feel a little bit of a calm before the storm, just in a similar way to sort of revenue. There's significant financial pressures on the programme. Mr. Galton talked about energy costs, and that feeds through into a lot of kind of construction materials. Steel prices are driven by the cost of kind of energy, as it were. So it's just going to kind of keep rippling through, and we are seeing the inflation on infrastructure costs rising significantly. And it's exacerbated. We've got this sort of twin pinch on us. It's not just cost pressures going up, but the demands for the capital programme has been sort of driven by the requirements of local plan. Again, Mr. Richardson pulled this one out, that it's kind of, some of it developers are going to fund, but actually some of it they'll sort of expect to sort of put on our shoulders as well. And I would draw attention, it's earlier in the report, to paragraph 3 in the report that went to Cabinet, and that's just trying to sort of, I suppose, emphasise the concern regarding the increasing pressure on the capital programme. And it's kind of to manage the affordability of the programme, we're going to have to sort of try and closely link it to the funding available, or even better still, again, as Mr. Richardson picked up, we can get the developers to do it and take on that delivery risk. That's kind of sort of the sweet spot where we'd like to be. But you can't necessarily always do that. So whilst we're always going to be mindful of our statutory duties to provide things like school places, make sure the highway safety isn't compromised, there could be adverse impacts of trying to sort of link that funding and delivery much more closely, if you can, particularly if the developer funding isn't forthcoming when planning permission is secured. The final block of the capital programme just picks up the corporate asset investment performance, and it was okay last year. Again, obviously, kind of slightly COVID impact, but to be honest, not much. It was one of the big reliefs at COVID, that there was enough quality and diversification in that sort of programme that it wasn't overly impacted by sort of one sector. And we don't, just to point out, we don't have the capital values at this point, but there's no real concern of those yet. The point I'd pull out is the illegal dumping of waste at First Farm. That hit the rural performance by a couple of £1 million. It's obviously a really, really unwelcome development, but CAFE was still comfortably positive overall from that financial perspective. So it is unfortunately a bit of a fact of life. If you're going to enter into sort of schemes that sort of try and make you money, at some point something's going to go wrong, and you're just going to make sure you've got enough diversification and enough and you're running the programme enough that these are kind of the exception rather than kind of a common occurrence. So that's all I was going to say on that.
Thank you, Declan. I think Mr. Galton, you've got a question.
Yes, thank you, Chairman. Obviously, the capital challenge is you're consistently identifying the MTFS with the infrastructure. On the one hand, we've got this massive demand for new housing. On the other hand, the infrastructure never quite. There's always a gap, isn't there, in terms of it? I know you were talked previously about how that can be risk can be shared with the planning authorities and the work that's going on there. So I'd like to understand where we are, because the last I heard, we could be looking at bespoke agreements with each one. They're different. But you're also saying to try and transfer some of that risk to the developers. Can you explain a bit more about how that would work? And so at the moment, if you take a school, new school, we collect the 106, don't we? And then we go out to a competition for an academy provider. But the likelihood is we would construct the school, build it, and then hand it over to the successful academy provider. Are you looking at changing that arrangement to transfer some of that risk? Because in my experience, the 106 is never quite enough, is it? It never delivers. And we've learned that on so many schemes. There's that gap, but we then have to fund from county council resources. So that's the bit I'm understanding. You're looking at trying to change that model and the way we've delivered. I guess it's mostly transport and schools are the two biggest issues.
I mean, it just in terms of that final point, you're absolutely right. It's roads and schools are the big one, and education in some ways focuses our mind more because we've got that statutory requirement to provide the school places. We have adopted a bit of a mixed approach to date in terms of whether it's the developer builds the school or we build the school ourselves. And budget for sort of statement, the obvious a little bit, but if it's a sort of a big sort of single developer development, it's much easier because actually they're quite incentivized to sort of build a school because people don't necessarily want the houses if if there's uncertainty about what the school's going to be, how good it's going to be, etc. So if it's a single developer, it's been quite easy in the past just to sort of push that responsibility, leave that responsibility with them, because often actually they're quite happy to do it and they'll pick it up. Where it's multiple developments all contributing a little bit into kind of into the sort of section 106 pot, as it were, that is where the sort of problems can arise. And you're right in your assessment, quite often section 106 can fall short. And in truth, in fairness to development, it's not all developer, it's not always their fault. You put inflation mechanisms in there to reflect that from when the section 106 money gets received, the point it's being built, what that's going to look like, but things like sort of standards of school can change in that intervening time. You know, environmental standards is a classic at the moment where there's much more sort of focus on that, but it can take several years before that school's due. So you can get shortfalls. So that's why we are increasingly trying to put that onus back on, you know, sort of the developers to either sort of collaborate or sort of to have sort of, I suppose, influence through the local plans to have much more kind of, I suppose, joined up development, that it can be that the developers have to sort of either build the school themselves, or we've got that certainty before we start building the school, we know how much money we're dealing with. But we can't control it all, and developers are quite shrewd as well, so they'll do things like pay money early if they think that's in their interest, because inflation's running high and the sort of the financial returns you get are lower. So it's kind of working with, I suppose, legal colleagues and planning colleagues to try and sort of gradually close those loopholes as they come due. But to be honest, it is going to be a battle, and you're right in what you say, that section 106 often falls forward, so every opportunity we get for the developer to do it will do. The first point you asked I know less about, but I do think it is going down that route of bespoke arrangements, that it's kind of, you know, in truth, different planning authorities take different approaches to how they sort of gain developer money as well. So it is sort of pushing us down that bespoke route.
So are you doing an assessment of how that funding mechanism might change because of the proposals that came out in the planning bill? Because initially they were talking about getting rid of 106 and moving entirely to a tariff infrastructure base, but now there's some doubt, and there might still be 106 for some things.
I think it's going to be a bit of a wait and see for the detail on that, because you're right, it's moving to kind of more of a land tax, which if you get the value of the tax right, could be helpful. If you get the value of the tax too low, it's not sort of helpful. But you know, we'll just have to wait for the detail on that one.
Anthony, did you want to make a comment here?
Thank you, Chair. I'm just going to add, thank Mr. Goulson for raising that point, for Declan for the response there's a lot of detail in the government's planning reforms and changes. We're all working through them to understand them. Local government and the development industry, and the devil's in the detail.
Thank you, Anthony. I think, Mr. Richardson, did you want to have a comment?
Thank you, Chair. Just a quick question, really. I mean, obviously, quite a few of the reasons for the slippages are well documented there. But I just wonder what work we've done on the cost of slippage, because the longer it takes, the more it costs. And the more officers' time we have to spend on it, the more time they can't spend on other projects. So have we ever done an analysis on the cost of slippage over and above, particularly in revenue terms, of that? And I know it's only a small amount, but I just noted is Romulus Court on here, which from memory is in Meridian. I mean, you know, I thought our policy was to be coming out of buildings, particularly when we got such high spare capacity here. So I wonder why we'd still be looking to spend on a building, or if we got a long lease that we can't get out of, which is why we're looking at it. That may assist us in, you know, every penny saved is a penny gained, as my mum used to say.
If I pick up the Romulus Court one, I can't remember the exact terms of the lease, but it does run for a little while. We have looked at coming out of it, to be quite honest. It's got all our kind of IT kind of backup kind of equipment in there, so there is a bit of a cost of doing that, but it is something we're actively looking at it. So yeah, because you are right, the more buildings we come out, the more we save.
Mr. Richardson.
Can I just come back and ask for an answer on my first point, which was about the cost of slippage? But before that, just one other final one, if I may, which is probably more a plea directed to the portfolio holder, is that at Adults and Communities on Monday, should Cabinet decide to centralise the records office in here, could we urge that the proceeds from the sale of the records office would be used to offset that, to hopefully make sure that scheme happens rather than just be absorbed into the central bucket, so that we can get that scheme off the ground. So it's only a plea, really, following our recommendation for Adults and Communities.
So in terms of the first one about the inflation, we did look at it about slippage. Yeah, sorry, I'm giving my answer before repeating the bit. So in terms of the cost of slippage, we looked at about sort of 12, 18 months ago, and at that point it wasn't too bad. Most of the slippage tended to be, I don't know, if you take things like school places, they were still being delivered okay for September, but cut money was moving between, I don't know, say February and April. So it looks bad in these reports, but actually the overall scheme wasn't too bad. And at that stage when we were looking at it, the major schemes weren't as major as they are now. But I think where your point is valid is we're in a very different world now. So if we delay a scheme for a year now, those kind of that infrastructure inflation is just in a different sort of ballpark, and it's much harder to mitigate. So I think when we looked at it before, it wasn't too bad. If we looked at it again, I think it'd be kind of much more of a concern. So it is one we're conscious on, and it's kind of the difficulty we've got at the moment is finding the sweet spot. So is there a benefit in not rushing to a scheme on the hope that kind of, you know, things with sort of steel market, etc., settle down, or actually is that just kind of wishful thinking and you're better off just sort of biting the bullet? So we are having a bit of a look at some of the sort of the gain share mechanisms with developers about who takes the risk on forward purchases and things like steel, to sort of try and find a better balance. But yeah, you're right to pull it out because the world's changed on this one. Oh, I'm sorry, was there another question there?
Do any members have any other questions or comments on this item? Okay, Chris, Declan, Mr. Brecken, do you have anything to add on this item before we move to the next one? No. Okay, so that moves us on to item 11 on the agenda, which is the recommended change to the annual investment strategy and investment in Christopherson, Robb and Company's Capital Relief Fund 5, which is on pages 57 to 64 of your agenda. Chris Tambini will again be introducing the report, with Declan Keegan and Mr. Brecken also here for the item. Chris, would you like to go ahead?
He's delegated. So the reason we're doing this is twofold. One is sort of the case progress is a little bit slower than hoped. Obviously, we're doing kind of quite a bit of sort of self-build, self-development in there, which kind of take a while. But whereas if you do these sort of investments in the financial markets, the sort of the money gets deployed much quicker. And the other one is that the cash balances are at a very high level at the moment, and the value is increasingly being eroded by inflation. Obviously, kind of despite the sort of the base rate increases, the very, very low risk investments that we tend to make on most of the sort of treasury management sort of side of things is far below those inflation levels. So while this won't sort of reverse that, it will sort of help a bit. And the other reason we sort of, and why this one I suppose is one of the questions, and it's not property as it were. So the CAIF is primarily sort of a property fund, which ties very well with that sort of economic development side of things. This is more of a, you know, we're just using this as a bit of a diversifier as well. So we've got that balance across the portfolio. And bank risk sharing is probably not something most people have come across. It's not really something that sort of you get access to sort of as a retail investor like most of us are as individuals. It is sort of restricted to institutional investors. And the sort of section of the report does get into basically quite a bit of detail about what's involved in it. But basically, if you just think of it as an insurance policy, so this sort of investment management company will basically insure against the risks of loans defaulting in return for obviously a premium. And the calculation obviously is that the premium is going to exceed the level of loans that default. And and you can sort of say, well, why would banks want to do that? Because actually that's banks' business is to sort of make loans and make those assessments. But banks have to hold capital, which is basically kind of just holding cash or holding very, very low risk investments to offset their potential future losses. So by them sharing the risk, they can reduce their amount of capital. And because capital is so expensive, actually you can tap into some of that profitability. The fund itself is kind of quite short term. The loans that are sort of getting sort of cycled are sort of quite short. So the fund returns all its money within 6 years, and that's despite kind of taking a few years to kind of invest the money, and then money will kind of gradually come back as well. And that fits well with our planning horizon. So when we're looking at this, we're doing it through the treasury management, which is our cash balances we're holding rather than specifically kind of earmarking money. So again, we can kind of manage it over that period quite well without impacting kind of other projects. And the firm Christopherson Robin company that we're looking to invest in, they've got a very, very good track record, and it goes back before the financial crisis, which is always quite a good test because obviously kind of loan defaults were kind of spiking and kind of quite bad around that sort of period. And it's also a company that the pension fund has used for a few years, so kind of it's had quite a bit of due diligence on. We've had sort of got quite a bit of sort of experience of their track record, which, like I say, is very, very good. It can sound a little bit counterintuitive why they target smaller firms to sort of reduce the risk a bit as opposed to sort of the big corporates. And it's all about predictability. So obviously when they're writing the insurance premium, they're having to guess at what defaults are going to be in the future. And if you look historically, big firms tend to have lower default levels, but spike horrendously when there's kind of sort of a severe recession. Whereas the firms they're targeting are much more kind of own and managed type firms. There isn't much of a developed small business sort of stock market in kind of Germany and Italy where they sort of tend to target a lot of these loans. So it tends to be kind of people are much more wedded to the company. So although kind of defaults might go up, they stay at a more similar level, hence they're just a bit more predictable. And a key feature of this fund as well, I've touched on this a couple of times before, is the importance of diversification. So they'll enter into sort of they'll back thousands and thousands of loans. So you're not restricted to kind of, I don't know, the risk of a big corporate going bust. It's spread over sort of quite a big pool of investment to go into there. And it's kind of a big feature of this as well is it's kind of the regulated transactions anyway, but the onus is still on the bank rather to manage these loans, and there's kind of quite a few incentives in there to make sure that happens. So the bank isn't off the hook by doing this, which is always kind of obviously a bit of a worry with the insurance arrangements. It's actually become quite a fundamental part of a lot of banks' business to do this. So I mean, the report does touch quite a bit on sort of the risks of this, and again, it's important to kind of get a bit of a grasp on that. But with the returns on this are far in excess of what we get from our treasury management at the moment as well. So the treasury management, we think we're averaging about 1.5% at the moment. You'd expect returns on this fund to be in excess of 8%. Obviously, with that extra return comes extra risk, but that balance of risk return does feel very favourable. These are kind of the dominant player in the market. They've got a very, very good reputation, very good access to data, which is actually kind of I suppose what this is all about. So risk might be higher, but that balance of risk and reward does feel okay. So hence that's why we're looking for sort of, I think it's just a £10 million investment to go to to go through sort of to the next cabinet. So just welcome comments from Commission or questions.
Thank you, Declan. We've got Mr. Phillimore first.
Thank you, Chair. So thank you very much for the explanation, and I completely understand why they're spreading that risk across multiple SMEs rather than big potential risks in single corporates or multiple corporates. I'm slightly confused about the dates, though, that are in this document. So if you look at point 13, it might just be a typo. It says that CLC were founded in 2022, but 2 paragraphs later, it says since 2004, CLC. So is there a typo date, or are they setting up specific hedge funds as single block investments and risk profiles?
So you're absolutely right. There's a typo in there. That should say 2002 is when the firm was when the firm was sort of was founded. I mean, you do touch on an interesting one as well. Actually, they do set up individual, kind of call it sleeves within it. So each one is kind of like a chunked up transaction as well. But you are right. That was an error. So apologies for that.
Oh, sorry. Okay, thank you. Mr. Morgan.
Thank you very much, Chair. I think it was just, I was obviously sort of reading the report, decided to do a little sort of searching to find out a little bit more about the organisation. It's not something that I've come across before. Obviously interested, came across an interview with Richard Robb, who's obviously one of their founders, describing his organisation as a hedge fund that invests in structured credit, which is obviously precisely what we're looking at. I think I guess I come with a slight sort of hesitancy because I used to be part of an organisation that had been bought by a hedge fund that was structured as an LLP, and got to know and understand how hedge funds work quite intimately, and particularly the LLP structure, on the basis that it's a very, very speedy way of changing over partners. The hedge fund that I got to know used to basically, the partners used to come in and out almost on a sort of conveyor belt, on the basis of the lowest 10 performing partners used to automatically exit the organisation, and they used to recruit new ones to fill the spots, and it was sort of incentivized to try and actually make sure that the performance was as competitive as possible, and certainly the structure of the LLP in the UK. Of the sort of 15 or 16 partners, there is a real age differential between those who seem to be born in the 80s and those who are born in the sort of 50s and 60s. And I'm assuming that probably the ones born in the 80s are those who are coming in and out on a regular basis, depending on performance, etc. Obviously, you've touched on the fact that it's quite a liquid investment, 6 years as a sort of locked-in investment. There's no secondary market in the investment, and therefore I suspect it's probably considered to be a higher risk than maybe some of our other investments, in the sense that we can't liquidate it with any comfort. We are locked in. We're there for the 6-year period, and certainly that's obviously part of the Christoph's and Rob's strategy as well. They talk about the fact that they are in for the long term, not for the short term. So they're not just constantly trading on the back of sort of the markets, etc. So I think on the basis that it's part of a balance. I think if we were going all in as an organisation on this type of product, then I would be extraordinarily nervous. Obviously, this is much more seen as being a slightly higher risk on the basis of greater return as part of a balanced portfolio, and therefore, whilst for our residents, £10 million is a significant amount of money, obviously as part of a much larger portfolio, it may well be much more of a prudent approach. It would be the sort of financial advisor's approach, which is some high risk, some low risk, some in the middle, much more are sort of balanced. So on a personal perspective, it may well be that many individuals would say, actually, this is too rich for me. I would feel nervous about this sort of investment. Us as a corporate body obviously would see this as being possibly much more of sort of balanced portfolio rather than necessarily a standalone investment approach. So I think it's more sort of commentary rather than a question. But I had to say it. Thank you.
Just pick up on a couple of those points, because you're right, I suppose, in the financial services thing, how sort of cut and thrust it is. But the one thing we do look at, or when sort of due diligence gets commissioned, is that kind of whole succession planning. Because Christophers and Rob, you've obviously picked up that both founders are still sort of heavily involved in running the business, which gives you quite a lot of assurance. But then it does give you a worry that actually, if they disappear, does the whole thing just kind of collapse on itself? But so quite a bit of work has been done on just on that due diligence. Is it completely dependent on those, or have they got those succession plan in place? And there's also, and that came back sort of a positive outcome on that. And the other thing is, this is a regulated market as well. So it's not just us looking at it, the regulator looks at this as well, that they're not kind of a weak link in the chain, because there's no point having a risk sharing transaction if the sort of the person taking on that risk is really flaky. So that's kind of why we like this one as well, where kind of it does feel that although the risk is much higher, as you quite rightly point out, it is lower compared to the return that you get than maybe some other sort of 8% return type businesses. But the final point I was going to touch on what you said is that it is part of that balanced portfolio. You're absolutely right. If we were sitting here proposing 200 million to go into this, would be absolutely crackers to do it. But just as a sort of small part to just kind of, the bulk of the fund is still in low risk type stuff, but it just brings up that average rate of return a bit. But, the chances of this getting hit, property getting hit, private debt getting hit, infrastructure getting hit all at the same time are just really low. So it just helps that balancing out.
Okay, thank you, Declan. Mr. Barclay.
Thanks, Declan. We've looked at this really through the corporate governance and also the local pension committee. We have actually got quite a track record with them, and the level of default on the loan, even in the sort of credit crunch, was 0.1%, whereas it across the board it was 3.6%. I think we recognise that it is higher risk, and it's a deliberate investment that we've made with looking to get returns of 8%. Track record that we have of the money that we've invested through the pension fund would intimate that it works, that this is a company which knows the market, is very active, and the risks are managed between 500 to 30,000 SME loans. So it's not something, and we've taken professional advice as well from Hyman. So whereas I do recognise, and I think members have quite clearly and correctly pointed out, that this would not be an investment for an individual retail investor, but as part of a balanced portfolio, I think this makes all the sense.
And Mrs. Hack.
Thank you, Chair. Councillor Barclay's actually given me a bit of reassurance. What the concern that I had actually is obviously the CRC been going since, it says here, since 2004. My interest was about its performance during the credit crunch. I think it is referred to in these papers about the real risk of global recession, and SMEs are quite often at the top of the list in terms of struggle. They just struggle to continue during recession periods. So that was the reassurance I was after. Is how did they perform during the credit crunch? We've got some choppy waters ahead.
I don't have the figures to hand, but in terms of, I can give you sort of a good idea in terms of they model obviously sort of the insurance premium under a range of different scenarios, and the kind of the credit crunch sort of scenario, they're still comfortably profitable. And in fact, even at twice the credit crunch scenario, it's still profitable. I think you have to get to 2.5 to 3 times before it gets to a break-even point. So it's got to be either a pretty horrible recession or a very kind of specific type one. But they've kind of the member earlier touched on, do they break up the portfolio into individual kind of almost sort of, they call them sort of tranches, and they do. So every time they'll release one of these, it's sort of separately kind of identified and reported on. And I think I'm right in saying of the ones that have been launching since 2002, I don't think any of them have made a loss. There might be 1 or 2, but in that kind of range, and there's sometimes all multiple in a year, the returns might not always be at that sort of target level. But the big thing is we don't want to lose capital, so they don't tend to fall into that sort of loss position.
Do any members have any more questions, comments on the item? No. Chris, Declan, Mr. Brecken, anyone have any final comments on it? No. Okay. Right, then we move on to agenda item 12, which is the annual report on the commercial strategy, which is set out on pages 65 to 82 of the agenda pack. Next, we have Chris Tambini again, along with Richard Hunt, who's joining us, and Mr. Brecken staying for the item. And thank you to Declan for answering lots of questions on the last two items. So if I hand over to Chris and Richard, thank you.
If I just kind of kick off, Lee, are you going to say a couple of words as well?
Yeah, I've got.
Yeah. So Richard Hunt is, I think, probably best known as our head of country parks, but he's recently kind of taken over commercial as well. So go easy on him, please. He has been to commission before, but his first time in terms of as head of commercial. We did a kind of minor restructure to generate some savings kind of earlier this year, so hence why kind of Richard's with us. I'm not going to say any more. I mean, most of the detail is in the report, and Richard will kind of take you through it. But clearly, it is another kind of coronavirus pandemic year. Has been a challenging year. I think personally, overall, I'm pretty pleased with the fact we've managed to mitigate the losses as far as we possibly can. And just given the discussion we've had early on, clearly it's going to be a challenging year this year, and I think next year is going to be a challenge as well on the commercial front. And we are doing some sort of more fundamental looks at some of our services in terms of how we might provide them in the future and how we might kind of turn them around to make sure they're more profitable. So I think there will be some difficult things we need to look at in terms of the commercial portfolio. But I'd say last year was a challenging year for obvious reasons. So I'll pass over to you, Lee.
Yeah, I think all that. I think the report it's well documented. I think it's disappointing, but I think we as a county council are not immune to the effects of COVID, like so many businesses out there. So with the staffing issues that we've had, cost of sort of resources and the materials that we need to deliver some of our services. I mean, I took in the report the increased costs that Richard highlighted in the report: 100% on cooking oil for sort of traded services, 75% on pasta costs. I mean, when you're delivering school meals across the area of schools that we actually do provide services for, it's a huge amount of money. So, but what I would say is, if you sort of looked at it, I mean, we have been realistic. I think the contribution that we're looking at going forward is a small contribution we're looking at. I think Richard's a good appointment. As I say, I think country parks have always been well delivered and excellent appointments. So look forward to Scrutiny's comments and questions.
Okay, Richard.
Thank you, and good morning, everyone. To kind of repeat, I suppose, the refrain from Chris and Mr. Brecken, this year has been really, really tough for all of our commercial services, and I think the report makes that very clear. And the MTFS figures were based on a faster recovery from COVID than in reality happened as a result of the Omicron variants and all the other things that are well rehearsed. Particular pressures for the service, I think, is kind of best categorised in three. The first one is pressures put on the service due to staff being ill, either with COVID or with dependents ill with COVID, or with us being struggling to recruit members of staff as well, given the really challenging environment within the whole of the hospitality sector when it comes to recruitment. As we came out of COVID and things started to be looking up, obviously the global geopolitical situation changed rather as well, which has put enormous costs on the service in terms of both fuel and food, particularly, and some of that set out within the report. And then the final element of it is the lower demand we've seen in some of our services as a result of COVID, particularly in schools where numbers have been very, very hard to forecast within the year due to the number of children being off sick at any particular time, and also services like Bow Manor, where particularly within the hall we saw basically an entire cessation of a lot of the conferencing and weddings business that we would normally rely upon there. I think it's worth saying kind of thanks are very much due to the team who have been working on the front line all the way through the pandemic. And that, you know, despite the figures not being as we would wish, you know, it's been a phenomenal amount of work they've put in there. I think for me, there are though some very strong and encouraging signs within the report. So our cafes at Beacon Hill and Tithe Barn had an exceptionally good year from a trading perspective, and we believe a lot of that demand will continue, and we're particularly delighted with some of those. Also, the trade at Bow Manor, particularly in the park, has returned to pre-pandemic levels, if not in excess of pre-pandemic levels. And the trade in the hall is now starting to return at a really, really encouraging rate. And also, it was a very good year for our LEMIS HR and professional services, which delivered a really healthy surplus ahead of target, and shows kind of the work they've been doing to diversify their offer and work very closely with our customers on that, which I think gives us real encouragement and confidence for this coming financial year. And the report sets out a number of the activities we'll be undertaking around streamlining and de-risking the offer at Bow Manor, also branching out into new areas for LEMIS and in organisational development provision for some of our customers, and also working very, very vigorously to maintain our margin position in our school food service and in our cafes. We'll continue throughout the next year to tender for school food contracts and ensure that in all those new contracts, the margin position is where we require it to be. We'll also take the opportunity to look at some of our legacy contracts and make sure that, again, those are delivering the margins that we would require. So obviously, it's worth saying, I think as a final element, COVID hasn't gone away and the geopolitical challenges certainly haven't gone away. But I think this report sets out a prudent way forwards for the next financial year.
Thank you, Richard. Mr. Morgan.
Thank you very much, Chair, and thank you very much for that summary. Particularly interested in, I think, sort of, obviously you're looking at a lot of the challenges and I'm sure constantly reviewing the portfolio to make sure that you know, the sort of changes that brought about by COVID are, if they are perceived to be more permanent changes, then we adapt. And I know obviously Bow Manor Hall I know very well because it's somewhere that is very close to my division, but also I've used it for my son in past school holiday activities, etc., etc. It has, I have to say, always been extraordinarily competitive. I think it's probably the best way of describing it compared to any of the commercial operations providing school places. And I know I don't know whether it's still carried on, but there always used to be a bus that used to go from this building to Bow Manor, which I'm assuming was for the benefit of staff here, for children to have sort of summer activities, etc. I think in light of that, you know, the question I would probably raise is it actually being run as a commercial operation? Are there, in view of the fact that the Defence Sixth Form College next door is no longer the Defence Sixth Form College, and whilst this is currently owned by a PFI company, at some point will no doubt come onto the market as a sort of future development opportunity. Bow Manor is probably a key link into Defence Sixth Form College, and it's just understanding whether there are constant reviews taking place given sort of changing economic and also potential markets adjacent to some of our properties. And I'm sure it's not just Bow Manor, it's also every other sort of bit that we operate. Just reassurance that is actually ongoing, that we aren't just assuming that for emotional reasons places like Bow Manor are considered to be untouchable, because, you know, we are, as we've discovered today, you know, increasingly finding it hard to cover bills. We are looking at investment on return, and clearly, you know, there is a commercial return on liquidizing some of the assets we have, or alternatively finding alternative uses for them.
Yeah, if I can pick this one up, obviously finance people don't have emotions, so it's one step in the right direction. Yeah, just to reassure you, we're constantly looking at options, and that doesn't kind of take Bow Manor out of the equation. So we are looking at options, and interestingly with Bow Manor is when you've obviously been around it and you're familiar with it, I mean, it is an expensive asset to kind of hold, and particularly the park, you know, in terms of the outdoor events bit, is looking a little bit shabby. So I think there is a bit of a crunch point coming where we need to decide whether we're going to invest or whether we can do something else with that asset. So yeah, we are looking at options.
Mr. Phillimore.
Thank you, Chair. I'm curious, and there's nothing worse than trying to manage and predict the unknown. So you've got reference to future plans for recovery, para 16. Greater profitability in our cafes as a result of improved margin positions through improved cost of goods ratios and revised menus and prices. And as we have already had suggested or covered, and we see in the media all day, every day, we have wage inflation, we have cost of goods inflation, we have raw material inflation. So I guess the question is, you know, the statement is in here. What does that actually look like as a sort of service offering? So, I mean, yes, I'm guessing you've reduced the menu size and perhaps got rid of some of the less popular items. But I'm really curious how you're writing that with the horrible backdrop that we're all facing at the moment, and trying to predict the unknown and cater for the unknown and provide a margin, an improved margin for unknown unknowns. So I'm just curious. Thank you, Chair.
I think, to be honest, a lot of it is the sort of the elements you've set out there. The margin position in our cafes could and should be a lot tighter to be best practice within the sector, and that's something that's been very clear to me coming in to start looking at this. And it will be improving that margin position is based around renegotiation with suppliers over the cost of goods. So because I think sometimes we've been using, you know, the same provider for a while, so making sure we're getting effective value for money through that. Also looking at the menu and ensuring that we're offering the menu that customers want, so we're reducing wastage within the service, and then also looking at pricing to make sure the pricing is well benchmarked within the within the local market and is making sure that it's delivering the correct gross profit margin.
And Mr. Galton. Yeah, just with all this discussion about Bow Manor Hall, I mean, there was a strategy for Bow Manor Hall some years ago. Mr. Brecken's predecessor had grand plans for Bow Manor Hall based on an investment strategy that was going to have a return. I think that included additional attractions that might be built in the grounds. I mean, is it this review that's going on that you referred to? Is it all that, or are we now just looking at sort of cutting and running? Because yeah, you don't do emotion, but there is a lot of history and attachment to that building that goes right back to its use in the Second World War. So yes, in the end, it needs to make money, but I would have thought such an iconic building, it ought to be possible in normal times, leaving COVID aside, it ought to be possible that it does wash its face and provides a return. Perhaps it needs to, I mean, traditionally it has been focused on schools, but more recently, you know, I think the previous director has said, you know, we can do weddings, we can, you know, could do all sorts of things there to get the income coming in. So I'm just keen that, you know, we're not looking at, you know, a backing away and getting out of it, which I think Mr. Richardson seemed to be suggesting we should go down that line. I would like to be more positive and look at how we can actually make it more attractive and therefore bring in more income. Thank you, Chair.
Yeah, I think if I may, we certainly had a paper presented a few weeks ago. It is a case of looking at all options. I think that there is investment, but there's also the repair side and the functionality. You know, as you say, it has to wash its face, and I think that is being looked at. I think historically it's been a big favourite. It has got a good history, and certainly many options have been looked at, but it's not it's not that we would, we know the value of the asset, and we have that, and we could look at ways to realise that, but we could also look at ways to make it profitable. So I think all options are being looked at, and I think that is what I'd say at the moment. So.
And Mrs. Fryer.
Thank you. Could I draw attention to pages 71 and 72 of the report, which is basically the school meals? And I know it's being looked at, whether they, oh right. I just find it very interesting that we do over 200 school meal sites, these sites, in Leicestershire and Leicester City, and we do 1 in Derbyshire, and 4 in Cambridgeshire, and 3 in Birmingham. Okay, we're doing well. We've got 15 in Luton. I really can't see how that can be viable. And are we locked into contracts with the one site in Derbyshire? I mean, goodness knows how much that costs. But I mean, as a layperson, if I had a business with 1 site in Derbyshire, I can't see how I would make any money out of it, because surely all the other sites in Derbyshire are being serviced by someone else. I do read in the paper on page 71 that this is being looked at, but I'm just worried whether we're locked into this and whether the meals that we're providing on the sites in Leicestershire and Leicester City are supporting these other 22 sites, 23 sites.
To cover off probably the latter point first, we started doing some far more in-depth analysis of our school food contracts, and we can definitely say that we're not subsidising the sites outside of county, so that's most definitely not the case. And for sites like Cambridgeshire and Birmingham, those are sites that we manage as a discrete cluster. They sit very closely together, which gives us the efficiencies and economies of scale there.
Sorry, Mr. Hunt, I can't see the geographical contact between Cambridgeshire and Birmingham.
No, sorry, the schools in Cambridgeshire are all very close together,
right.
And the schools in Birmingham are all very close together, and are managed within existing teams. And it also gives us the opportunity to be moving into those markets in those areas by acquiring additional contracts as they become available in the vicinity of those areas, which is part of the strategy of growing the service offer. The Derbyshire school, obviously, sometimes, the boundaries between the counties, there's schools that are close to the boundary, and therefore that's geographically closer to some of our other sites. So all of those contracts do make financial sense, and it is something that we are continuing to look at to ensure that's the case.
Thank
you. Mrs. Hack.
It was just following on that thread, actually. I mean, whilst I understand that these are financially viable, long term as an authority, are they viable in terms of the environmental impact it would have to be physically taking stuff out of county? So that's that element. But has the school meal service returned back to breaking even and plus since the pandemic? Obviously, looking forward, it indicates that probably is the case, but is it now starting to make surpluses?
Certainly on the environmental impact, it's fair to say we wouldn't operate any of those contracts by shipping things over from Leicestershire to deliver them. So, all of our suppliers will deliver direct to sites. So that kind of, is definitely something we look at there. Give me, I've forgotten the second half of the question. Oh, right, yes. And in terms of school food numbers, we saw a distinct uptick in school food numbers and a return to the levels we would have expected in March, April and May. So that's what gives us a lot more confidence in the future compared to the performance over the past 12 months when it was very up and down with COVID.
Mr. Richardson, did you have a hand up earlier?
I did. It's my favourite subject, so I've got about 300 questions, so you might have to bear with me, Chairman. If we start on paragraph 11, I think it is. Lost it now. Sure it's the right one. But Got the wrong report now. There we go. Yeah, I mean, we say in paragraph 11, second sentence, our hospitality offer is not so evenly spread with our cafes at Bowman Hall being located, etc. So number one, what action are we taking to ensure that we, as a county council, provide a county offer? And in that respect, I note from the report that the cafe at Snibston, which is losing a huge sum of money, and the Snibston Country Park, we run free events at. Well, that's free events for one part of the county. What free events are we doing for the rest of the county, in particular the people who live in my division? And why are we so geographically centric on one area, and why are we not evenly spread? When we looked at this, well, in fact, when we've looked at this every year, we've always requested that we get the full costs of running the service. But even within the report, it says the loss at Bow Manor is massively understated because all of the work we're doing on it elsewhere, which are held in other budgets. Well, I thought the Scrutiny Commission looked at overall everything, and therefore this should have been a consolidated report across all the budgets. So what was the true loss at Bow Manor Hall over the last 12 months, as opposed to what's reported in here just on traded services? When it then comes to schools, I mean, presumably, should the contracts for school meals not have included an uplift to schools to avoid us taking the loss rather and the schools paying for it? It's their schools, they get the budget, but we're showing a loss of 400,000, which we're actually saying is made solely in Leicestershire, which would imply our contracts we sign in Leicestershire were not particularly well written. And is that something we're looking at, of what those contracts say and how they operate going forward? And under paragraph 16, where we talk about plans for future recovery and growth, would it be possible to have a copy of the action plan with targets, with dates, with what we're going to do by when? Because, I mean, I could say this is what we're planning to do in the next year, but I've got no idea, sitting on this committee reading this report, what we're planning to do within the next year. And at what point are we going to make the decision on some of these things on viability? So if you've got Beacon, which is making a fortune, and Snibston, which is making a massive loss cafe-wise, is it because of the demographics of the area? Is it because they're too close to other cafes? Is it a cafe in the right place? So again, what is the ongoing viability of that cafe if you've got one? And should these not be things that perhaps we outsource rather than run ourselves, that we sign a lease with a professional company to run it for us, where we get a set amount each year and a profit sharing agreement, as many other areas do? I just wonder if we're looking at this in a truly commercial sense, to ensure that the council gets best value for this. Because at the end of the day, the overall package should be is, if we don't do the service, what are the savings that we would actually make by not employing all those staff and doing all those things against the cost? So if the savings are greater than we're actually getting in income in, so with no comparison on cost versus income, I can make no subjective decision as to whether these things are viable.
There are lots of questions in there. If I kick off, but if Richard, if you could pick up the school meals and maybe talk a bit about the SNPs in terms of what we're planning there. In terms of, I suppose, the geographical split of our hospitality, to be honest, it follows the country park split, which is clearly kind of based on history, where the former coalfields were and the rest of it. And I know Scrutiny has discussed this in the past about this band of country parks that runs across the middle of the county that doesn't really go to the edges. So I mean that's really why the hospitality is where it is, because it's based within our country parks. Written down Bow Manor. I can't remember the question around Bow Manor. Oh yeah, Bow, in terms of all the costs not being in there. Yeah, fair comment actually. We'll get you the figure with all the costs reflected in there, and we'll also, I'm quite happy to share the action plan once we've got the action plan produced. So I'm not a problem doing that, and I'll pass to Richard and pick up the school meals and the Snibston points.
So on the school meals point, in terms of kind of sharing the risk of the downturn during COVID, that was something that was done with schools. So certainly I think the losses would have been significantly greater had we not put in place some of those things that were there. A lot of the increased cost there will be around staffing costs, and also as cost of goods has fluctuated, and some of those are not reflected within the contracts at the moment. We have already modified contracts to transfer some of the risk away from us, so we are definitely in a better position than we would be on school food, and going forwards all contracts are being very carefully looked at when we tender for them to reduce our exposure to risk, which is making tendering for contracts very challenging, as it says in the report, because there is so much unknown in terms of a lot of our costs at the moment. The other point raised was about viability of services, and particularly things like Snibston and the cafe there. Obviously, as you can see, the cafe's made a significant loss this year, and we are working at present to outsource the cafe offer at Snibston, and that's something that colleagues are working on. And so we expect to see a profitable cafe bringing in a return to the local authority shortly at Snibston. And the viability of all of our hospitality services is something we keep a very close eye on, and we'll look to make changes to if required in the future. But certainly Snibston will see some significant changes over the course of the next few months. In terms of the margin position for all services, we've tried very hard to make sure that the costs and income are reflected. So on page 1881, you'll see the overall contribution or loss of each service. So that is the costs over the income for that service, taking on board the point made by the Commission last time that sometimes we were only stating income to service rather than the costs of the service or the contribution made by the service.
Thank you, Richard. Mr. Richardson.
Just come back on that one. I'm slightly puzzled on that one. So if we're not showing Bow Manor as reflective of the total cost, presumably we're not showing any of the others as reflective of the total cost. So if we're only comparing costs of goods that we produce and taking the margin against cost of sales, and we're not taking into consideration the MRP, the cost of running the building, the cost of maintaining it, etc., we're not actually making a return. No company would say, I'm making a return if we're not making a return. So what I've always been trying to get to, and I've got no problem with running these facilities and making them as good as they can be, but are they making a return to the council when all costs and other considerations are taken into impact? It's then a decision for the council whether they wish to continue those running at a loss, which I've got no problem with as a democratic decision. All I'm trying to get at is, do we have sufficient information to make a value judgment as Scrutiny Commission comment on this report if we haven't got all the information? So I suspect there was a cost of building the cafe at Snibston. That's in MRP for the next year. If the MRP cost isn't in there, we probably won't make a profit for 10 years. Now, that's fine if that's what we planned for and budgeted for. But to actually show a chart that shows a contribution when it's not a contribution always slightly worries me.
We had a bit of a discussion around this because we did look back at the minutes of the last meeting, and it is a bit of a balancing act in terms of the information that we can provide, in terms of the detailed information we can provide to Scrutiny, because clearly we operate within markets with all these services. And I mean, what I will say is, if people want to see the more detailed trading accounts kind of privately, there's not a problem with seeing them, but we kind of stuck with the kind of a bit more information in this report than last year, and more narrative around it rather than giving the detailed kind of trading accounts. But we are kind of happy to share the more detail if you want to see them. So yeah.
Rather than each person doing it, could I not? I mean, we could do this through an exempt report. So the information is still within this room. It doesn't go outside. Most councils do exempt reports. Would that not be the way forward? And it saves lots of people asking you, or perhaps one or two people looking at, we have an exempt report.
Yeah, that's something we can have to show, something we can look at. I mean, maybe we could do a bit so we have a bit in public and a bit in private, so that you get maybe you get a detailed appendix in private.
Yeah. So we could do the exempt report or some of it in public with the action plan as well. Okay. Any other comments, questions on this item? No. Richard, Chris, Mr. Brecken, did you want to say anything more on this item, or is that everything for this one? Okay, well, thank you very much to all of you for coming along today, and to Chris and Mr. Brecken for staying for the 3 items, and Richard on this item, which moves us on to item 13, which is the corporate complaints and compliments annual report 2021-2022, which is at page 83 of your agenda pack. Simon Parsons, who's the customer relations manager, is presenting this item. If I hand over to you, Simon.
Thank you, Chair. So this report is the first of 3 complaints annual reports for the 21-22 year, and briefly it covers all complaints considered under the corporate process, which really is anything that's not social care related, which have separate annual reports and will go through to the respective scrutiny and overview committees later in the autumn. I would just acknowledge there a slight typo on page 85, which reflects that those reports were to the June scrutiny overview committees. Should be September, so apologies for that. The report sets out a 16% increase in complaints, and that continues a year-on-year rise really over the last few years, as illustrated on the graphic of page 93. So fairly consistent rise there, with 610 new complaints accepted. And I guess that rise over the last few years, it's fair to say, is placing some pressures both on some of the services and indeed the complaints team during the year, and that's probably best reflected in some of the pressures on response time scales, which have dipped a bit through the last year there. The key areas driving that increase were really special educational needs assessment and transport for special educational needs students. And clearly there's heavy interlinkages between those 2 areas. Specifically with transport, a lot of the issues were very late decisions on where students would be going to school, which made it very difficult for the transport team to get transport in place for the start of the academic year. So we saw a heavy volume through around the autumn period there of parents understandably complaining that they had no provision in place due to the knock-on impact of that. There was also a reasonably significant rise in waste-related complaints. That's since stabilised and really was primarily down to a change in really that whole service delivery through the pandemic, where we had to at pace put in booking systems, and inevitably when you're building technology at pace in that instance, there's going to be some failover into the complaints territory around bookings either going wrong or issues with that system working. In the context of the huge numbers of online bookings that were going through that process, it's relatively small, but it's really that's kind of the main reason those numbers went up in the waste area, rather than any kind of more underlying problems out in the service there. The report sets out on pages 95 and 96 some of the actions that are being taken to drive some of the improvement, particularly across the SEN and transport areas. And I'm plugged into some of the conversations going on at the moment around that. I would just, however, flag a note of caution. It's unlikely that we're going to see significant improvement or reduction in those volumes through this year. Some of that work is going to take a while to filter through into complaint reductions. There's lots going on, as kind of highlighted in the report, but it is going to take some time for that to show through. So just a note of caution around some of that. In terms of Ombudsman activity, we fully expected we'd see a rise in the numbers of decisions made by the Ombudsman, and that was really inevitable because in the previous year they effectively closed for 3 months during the height of the pandemic and weren't progressing any casework, so it was inevitable that those numbers would increase through that area, but not disproportionately for the numbers of complaints there. No public reports were issued during the year, I'm pleased to say. and indeed we saw lower levels overall of financial compensation ordered by the Ombudsman compared to the previous year, which again is encouraging despite the volume increase. At the same time of all of this, we also saw compliments increase slightly. So 226 compliments came through my team. It's important just to reflect that in a challenging environment, there's still a good number of compliments coming through, and important that balance is in the report there. I guess the other key point to make really is again reflective of some of those pressures, particularly in terms of complaints investigation and response times, as there will be additional capacity coming on board into my area really imminently in July, around just helping to boost some of those areas that are struggling, where managers are struggling with responding to the complaints effectively. So that will specifically be social care and SEM related, but will certainly help with some of those pressure points around that area. I think those were the key messages I want to give, but very happy to take any questions.
Thank you, Simon. Mr. Galton.
Yes, thank you, Chair. Yeah, this is quite worrying, because historically the County Council had a very good, very low rate of corporate complaints, and it's been going up now for a number of years. And obviously, particular issue in the pandemic, that's bound to have had an impact. But I think I'd be interested in seeing some comparison data with other county councils. I think that is something that would be interested in looking at, Chairman. Particular issue then is obviously if you put together SEN and SEN transport, well over 200 complaints in that area. Looking to my left, the chairman of Children's, that is something I would definitely be looking at. There's obviously an issue there. Maybe you already are.
Yeah.
But I do think that Scrutiny needs to look at what is going on in SEN. I suspect a significant amount of it is because of government action or inaction in relation to funding, and also the systems that are in place, although there's to be some further changes to that as I understand it. But nevertheless, the fact that we were unable to get transport organised, that is not really an acceptable excuse. Once the child knows where it's going to school, the transport should follow within a matter of days. We should have systems in place that allow that to happen. And if it's staffing resources, then we need to do something about that pretty quickly. If I had a number of cases myself where people just weren't getting responses, and we had to get the director involved, find out what was going on. The communication was not coming out of that team fast enough, or actually addressing people's concerns. And I think they were under pressure, no doubt about it. So, we need to learn from that. And if it's just a temporary short period for a few weeks or a few months, put people into that role appropriately for a short period, because, these are statutory functions. They're not something that's nice to do or something we choose. This is a statutory duty on this authority to deliver, and 200 complaints is just not acceptable, Chairman.
Just to pick up on a couple of those points, in terms of benchmarking, that's certainly something I can look at. What I would say was certainly we do some benchmarking in terms of looking at a high level from complaints that reach the Ombudsman and numbers that goes to Corporate Governance Committee later in the year. There's some benchmarking of statistically comparable neighbouring authorities there. In terms of looking at it through corporate complaints, it's notoriously been quite difficult to do that, because being a non-statutory complaints process, all authorities are set up slightly differently, and you sometimes end up not comparing like for like. But certainly I sit in a regional group of complaints managers, and it's something we do talk about a lot. So very happy to look at seeing what I can do for future reports on that. In terms of the comments around SEN and transport, I entirely agree. It's clearly a big rise. In terms of transport specifically, we have got some external consultancy work going on. It is in place now, so we've got a company that are very deeply experienced in the whole area of transport on board, working closely with us, as are our transformation unit, in terms of trying to work across those two areas of SEN and transport, which, if I'm honest, typically have worked a little bit in isolation, so haven't necessarily seen the same priorities in terms of that work, and not necessarily been as focused on the overall impact on the families as they perhaps should have been. So that programme of joining those areas, understanding some of that demand, and just being clear around what we know. I think last year, part of the problem was we simply had no view going into the autumn, or the transport team had no view of the numbers that were outstanding of SEN students that didn't yet have an allocated place. So it really caught them on the back foot in terms of being able to then commission that transport. So there's a lot of work around knowing where that is. If nothing else, then we can be proactive around, even if we haven't got transport on board, we can put temporary arrangements in place, whether that be some temporary funding streams to help families and things like that. So those conversations are going on as well around being a bit more proactive this year than perhaps we were last year. So lots going on, and certainly I can confirm that around that area. Have I missed any points? Sorry, there. I wasn't sure. I've missed another comment that you made.
No, thank you.
No, thank you.
Thank you, Simon. Mr. Finnemore.
Thank you, Chair. I absolutely appreciate this is actually straying into an operational issue by department. So Mrs. Fry may have some insight for me. My experience, and yeah, my wife has worked in SEN for a very long time, and particularly early years, so I kind of have a background understanding. So I'm curious, and certainly my mailbox when these matters arise, principally starts with SENA. It's actually the early stage assessment, and historically we have had challenges with the actual physical resources of those professionals with the skills and the expertise and the Oki Health to actually make those assessments in the very first place, which undoubtedly feed into, you know, this sort of more amplified picture. So I'm just curious, either Simon or perhaps Mrs. Fry, do you have some understanding or insight as to what we're doing and how we can actually speed up that assessment process? Because if we speed up the assessment process and we get the services in place and the support mechanisms in place, actually these complaints will reduce by default, which will undoubtedly also feed into the transport complaints as well, because the two are intrinsically linked without any shadow. So can I just sort of open that conversation just out of pure interest for the committee?
You wanted to speak, Chris?
Yeah, don't mind kind of chipping in. I mean, SEN is a massive financial problem as well as a service problem. I suppose they both stem from the same thing, rising demand. So you've got massive demand. I can't remember the figures, but I think over recent years, best part of 10% increase in numbers of children getting assessed, or EHCPs, per year. So there is a massive increase. We are at the moment kind of looking at getting some support into that service. So to pick up your point about kind of how we can make it kind of work a lot better, and there's a few aspects to that. I know we've talked about this before. This kind of leftward shift thing, where you know we have less people in private, less children in private kind of in private special schools, more kids in our own special schools, more kids supported in secondary schools and primary schools. So we are looking at that, but we have come to the conclusion we do need to make some support to do that. So we're currently kind of assessing some tenders to see how that support might look like, what that support might look like. But it is something that hopefully we can get under control, and it's sort of the financial issue, the complaints issue, and the demand issue all at the same time. The final thing we'll add, and I've said this before, is that we are not alone. You know, the figures that the Society of County Treasurers does an annual survey, which we're just compiling at the moment, and I think that's going to show the cumulative kind of deficits, which are a good indication of the increase in demand, are going to be approaching £2 billion for county councils in a couple of years' time. The figures are huge.
Thank you for that, Chris. And I think really interesting. My wife's just been on an autism course. She's been doing it for years. It's more of a refresher for Jackie. But what she came back with was a really stark statistic, which really does paint the picture of. So when Jackie started in special needs, it was something like 1 in 300 children were diagnosed as being on the autism scale somewhere. Spectrum, and it's now 1 in 60. You know, in the space of 20-something years. I mean, it's a vast increase in demand. Now, some of that is down to better diagnosis and assessment, but it doesn't alter the fact, as a county authority with a statutory responsibility, 20 years ago it was 1 in 300, and now it's 1 in 60. So some really scary statistics which the officers and members are having to deal with. So thank you, Chair.
Mrs. Graham.
Thank you. Thank you, Mr. Galton. You may be, and all members and the officers, that we are very aware of this and we are very concerned and we are working our best to do it. The other problem is, as Mr. Fillimore has indicated, the numbers in the last few years have just skyrocketed. And also, the more complicated. It hasn't, I'm not making excuses, but it did not help during the pandemic. There are a number of young people and children that may have to have 3 people with them to get to school. And you cannot put them in a minibus with 4 other children. You cannot put them with just one carer. And of course, also, as we know in other sections in the world at the moment, in other things, we also cannot always have someone on standby to immediately step in. All services have suffered from the fact that the COVID, and I know we keep saying the COVID, but people would wake up in the morning expecting to take 2 children to school, but have suddenly found that they've tested positive. So that has to be cancelled. And of course, you cannot then just have people standing, waiting. The vehicles may be in the wrong place. The driver may be not able to go, but the escorts can. So you are, as the officers have said, and we had a meeting yesterday, and our vice chair is here, and I think you'll find it very interesting to read through some of those papers. We are taking more professional advice, but if it keeps rising at the level it is now, I don't know any council or any organisation how we can manage it. But you may be reassured, I think all of us in this room, particularly the councillors, have received problems from members of the public very worried about how they're getting their children to school. And we do have a statutory right, but and we do it as quickly as we can. There is also the other side of it, which is the assessment. So someone can present themselves, or parents or carers can come and say that there's something wrong through the school. Well, is it an ECHP? Is it a SEND? Can they be with other people? And this takes time and expertise. I mean, I couldn't do the assessment. I'm not qualified. And you're in competition with other counties as well. We're working very hard, and it was pointed out to us by the director yesterday, and Mr. Smith will correct me if I'm wrong. We are now doing a lot more work where we are getting our own staff, if you like, trained. We've had an enormous sort of push on apprenticeships and people that will then be coming on stream. I think I'm right, aren't I, Craig, in the autumn. So rather than relying on agency staff, because that is an enormous expense to the council. And then, of course, I believe I'm right in saying that the transport side of it doesn't come under children and families. So we may be doing things in children and families, but the actual transport is in another director. And I think that's something we've got to revisit and relook at so that it works much more closely together. Thank you.
Okay. Did you want to come back, Mr. Phillimore?
I was shocked.
Very short. Because it's always good to grab positives when we see negatives. And my understanding is that nationally, through COVID, the rate of complaints has increased. Full stop. So that has to be taken into consideration. But I think as a divisional representative, every engagement I have had, particularly with Children and Family Services, has been fast, it has been efficient, and it has principally, the Senate side of it is the one that's really challenging. I think that the assessment side, but actually the Children and Family Services, they do a crackingly good job. Thank you, Chair.
Mrs. Hack.
Thank you, Chair. Just to sort of finish off on sort of the send scenario is Chris outlined it really clearly. We've got massive financial pressures, so that will drip into complaints. What I'm really interested in, I mean, I look at complaints in my work life. It's something that, you know, I do service improvement, so that's something that I look at too. And one of the things that I always find really interesting is, whilst the complaints might be separated in terms of service areas, the common thread is communication, actually. And I was wondering whether or not we'd done any sort of cross-cutting analysis across those threads about what is the crux of the actual complaint. Are they upset by service, or are they upset by the fact that they don't know where their complaint is, or where their particular where they're going to get a response? And I didn't know whether or not there was any analysis that we could see as sort of divisional councillors in terms of the kinds of complaints that happen per division, or is there anything common? Is there any themes that come up geographically, as well as through the spread of detail of what we get here? Because that might identify a particular service area or potential problems that is more geographical based than it would be service based. Thank you.
Yes, we do have some recording around themes of complaints. So we have a number of indicators, and sometimes we'll record multiple against some. So typically things like delay, communication, decision making, things like that. And I can certainly look to include that in kind of future reports in terms of what that comes across. In terms, if I look at last year and certainly the areas that I've highlighted as being the key contributing factors, then I think I would say the two dominant ones, and often they are a bit interlinked anyway, is delay and communication. So it's the fact that the time being taken to either arrange transport or issue a plan in Centreworld or deal with or schedule an annual review, and then the expectation management of that and the communication and that difficulty getting through to SEN officers was a challenge. So those are probably the two main areas. There will inevitably have been some issues around the challenges around placements within that as well, but they don't feature as prominently as you might think in this report. And the main reason for that, particularly in the SEM world, is that actually if it's solely about a disagreement around whether a placement can meet needs, they go through the tribunal process rather than the complaints process, so often don't feature as. So that kind of decision making around, I disagree that place can meet needs, doesn't necessarily tend to come into the complaints territory, or if it does, we redirect them into the tribunal sort of remit. So yeah, in terms of that analysis there, it would be very much square. It would be, yeah, communication and delay would be the key ones. Geographical data is a challenge, if I'm honest, simply because we don't always have the metadata behind it around where people are from. Sometimes we're dealing with complainants with only an email address or only a phone number, and we don't necessarily, to resolve their complaint, necessarily need to take everything. So that can be a challenge. I can certainly take another look at it and see what we can do. It might be with partial data sets with some kind of caveats that we don't hold all the data, but still might throw up something. So happy to take a further look at that. I suppose the only other comment, just to come back on previous ones, again, just wanted to echo that the point that this is very much a national problem with Senna. It's certainly the latest data. I'm fully expecting this won't change when we get the annual review letters from the Ombudsman this year. They're upholding 90% of SEN complaints across all authorities. We're certainly not alone around that, and certainly they see it as their biggest issue out in local authorities. So yeah, very much wanted to kind of re-emphasise that point.
Mr. Pendleton, did you?
Chairman, thank you. It's been well and truly sorted by Mrs. Fryer in particular, and by our speaker. Thank you.
Okay, Mr. Smith.
Very similar to Mr. Chairman. Most of mine have now been raised, but I'd just like to put on record that obviously the service is under massive, I'm talking about Sen here, massive and exponential growth. And of course, they're intrinsically linked, the number of growth, to the number of complaints as well. So whilst the numbers are frighteningly high, they are not dissimilar to perhaps previous years when we had less demand on service and obviously a similar amount of complaints. But one thing that particularly the Children and Families Department do is a fantastic job, and they do get to the bottom of these complaints very, very quickly.
Do we have any more questions, comments from members? No. Okay. Simon, Chris, Mr. Brecken, do we have anything to add? No. Okay, thank you. So that's the end of that item, which moves us on to the final item on the agenda, which is the Overview and Scrutiny Annual Report 2021-2022. A copy of the draft annual report is attached to your agenda, starting on page 111. The report is backward-looking and outlines the key work undertaken over the last year by the Commission and the 5 other standing overview and scrutiny committees. The commissioners and the chairs and spokespeople of all scrutiny committees have been given the opportunity to comment on the draft now attached. Subject to approval, the annual report will be submitted to the full County Council for consideration at its meetings in July, but really looking for members, any comments, observations on the report? Mrs. Hack.
Thank you. I mean, as always, these reports are incredibly good summaries of all the work that's been done through scrutiny committees, and it's always welcome to see. I think the only comment that I would have is obviously how to get involved, and we talk about how members of the public can get involved. And I know through Health Scrutiny Committee we've had a petition that's been released this year, and it's a shame not to see that represented, because that's 1,300 members of the public that have signed something. They've come to this council to have a look at something, so it'd be really useful to see if that could be added, please.
Yes, agree. The petitions are a good way of the public getting engaged on issues that affect them. Do other members of the committee have? I'm sorry, Mrs. Payne.
I beg your pardon, because this report is always backward looking. So your comment is noted, but it will be reflected upon in the next annual report. So there will be a reference to that then and there. Right? Am I correct?
It depends on the petition.
The petition was submitted in January.
There you go.
Mr. Morgan?
I was just going to say, I mean, it is actually a live response. So actually, I suspect it's probably when it actually concludes is probably the best time to actually demonstrate. But yeah.
Do any other members have any comments, observations on the report? No, just to say it seems to be a very clear document that sets out what's done by the commissions, and a huge thank you to all the officers who've helped contribute towards drafting it. So if there's no more comments on the annual report, we move on to item 15, which is the date of the next meeting, which is scheduled to take place on the 7th of September 2022, starting at 10 in the morning. And no urgent items on the agenda, so that's the end of the meeting. Thank you very much for everyone who attended today and for all your questions and contributions to the items. Thank you.